Welcome to this explainer. Okay, let's dive right into this because today we are unpacking a truly fascinating market dynamic. It is August 4th, 2026, and the London market is staging a major rebound right back toward record highs. But, if you look beneath the surface, there's this massive fracture. It's a true dichotomy where these massive winners are basically masking some really shocking losers. So let's get into it and uncover this tale of two markets.
Real quick, here's how we're going to break it all down today. First, we'll look at the broad market rebound. Second, our massive winners in energy and mining. Third, the big losers in healthcare and consumer stocks. And finally, we'll put it all together to see what this tale of two markets really means.
All right, Section 1, the market rebound, a global wave. So the FTSE 100 is trading firmly in the green today, up about 0.5%, which puts us sitting at 10,912 points. And this upward pull, it's actually part of a much bigger global wave. We're seeing optimism imported from record highs over in Europe, plus that massive tech-led rally happening in the US. So, despite all the lingering geopolitical uncertainties in the Middle East, strong earnings are literally lifting this index right out of 3 consecutive days of losses. Heck, even the mid-cap FTSE 250 is sitting near a 6-year high right now. Let's move on to Section 2, winners, the energy and mining boom.
$5.7 billion. Just let that number sink in for a second. That is the blockbuster second quarter underlying replacement cost profit just reported by BP. I mean, it's a staggering figure. It completely blew past analyst expectations and, no surprise here, sent the energy giant gushing higher today. And this brilliantly illustrates the sheer scale of the commodity boom we're seeing. That $5.7 billion figure, it's literally more than double the profit BP posted during the exact same period last year. They are just riding this massive wave. We're talking higher global energy prices, incredibly strong realized refining margins, and a really robust performance from their trading division. It's the whole shebang.
But actually scratch that. It wasn't a totally flawless quarter. BP's new CEO, Meg O'Neill, was pretty candid that upstream plant reliability dipped a bit and production was down, partly because of maintenance. But she isn't just sitting still. She is taking bold, offensive actions. She's aggressively restructuring, selling off their North Sea business and the U.S. biogas unit, Archaea, all while simultaneously boosting the dividend by 4% to keep those shareholders happy. Now, alongside BP, the mining sector is absolutely the second massive pillar holding up the market today. You've got Antofagasta up nearly 4%, and they're closely followed by Glencore, Anglo American, and Rio Tinto. And it all boils down to basic supply and demand. Falling global inventories have pushed copper prices to a 2-month high, acting as this huge macro tailwind for these guys. Okay, before we pivot to the losers, we're actually seeing a classic buy the rumor, sell the news scenario play out right now with HSBC. The bank beat profit expectations and announced a massive $1 billion share buyback. Sounds great, right? But after hitting a record high early in the session, the stock actually slipped as investors locked in their profits the very moment the news was confirmed. A textbook market psychology move.
All right, time for Section 3, losers, healthcare and consumer.
Talk about whiplash, right? Minus 7.2%. This is the top loser on the FTSE 100 today, the medical technology firm Smith+Nephew. If BP is today's superhero, Smith+Nephew is providing a very harsh reality check. Shares have absolutely plunged. Now, what's really interesting about this slide is the actual catalyst for the sell-off. The company essentially took a hatchet to their full-year revenue growth forecast. They had previously guided investors to expect 6% growth, but today, they slashed that down to just 4%. Combine that nasty guidance cut with a Q2 revenue miss, and, well, the market's reaction was incredibly swift and pretty brutal. The main culprit behind this drop is persistent weakness over in their U.S. orthopaedics unit, specifically in hip and knee implants, which, by the way, is their biggest market. So unlike BP's Meg O'Neill, who gets to make offensive moves from a mountain of cash, Smith+Nephew's CEO Deepak Nath is stuck playing defense. He is banking super heavily on new product launches in the second half of the year, like their new cementless landmark knee system, to help them bounce back. But for now, investors just aren't willing to wait around. Finally, Section 4, a tale of two markets, the final tally. So the crucial point is this. We are looking at two entirely different economic realities coexisting on the exact same index today. On one side, you have a market being violently driven upward by a massive commodity boom. falling inventories, and sky-high energy prices. On the other side, a consumer slump plagued by slowing growth and incredibly weak sales in defensive sectors like healthcare. It's a total market of haves and have-nots. And unfortunately, Smith+Nephew has plenty of company in the red today. Defensive and consumer-facing companies are taking a beating across the board. You've got Coca-Cola Euro-Pacific Partners dropping 4% on slowing growth. Pearson is down 2.5% right after a Goldman Sachs downgrade. Even a beverage giant like Diageo is seeing declines. It's a stark reminder that while the energy sector is throwing a massive party, the environment is incredibly challenging for companies that rely on everyday consumer spending. Which leaves us with one vital, fascinating question. Can a market rally sustained entirely by surging commodities survive if consumer and healthcare companies continue to crumble? Basically, if the everyday economy is struggling, how long can heavy industry carry the entire weight? It's a massive dilemma, and it's for sure something we'll be watching closely in the days ahead. Thank you so much for joining me to unpack this today. Keep questioning the numbers, and I'll catch you in the next explainer.